Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Now today on Geared for Growth, I'm joined by someone who has spent over 40 years doing something most investors wish they had the time or patience to do. Actually research what truly drives property performance. If you've been in the property space for more than 5 minutes, you've heard the name, Terry Ryder. He's the founder of Hotspotting.com.au, one of the longest standing voices in property research. And after 2 decades, he's just released a brand new book, Why Property Values Rise. Now, I wish I could tell you that in the next 30 minutes, we'll magically transform you into a property genius. But as Terry explains, the real world of property is far more nuanced than you might think. Today we unpack everything from rookie investor mistakes to why ugly real estate often performs the best and why units are quietly outperforming houses in more markets than ever before. If you're serious about understanding what makes markets move, not just the headlines, not the hype, but the actual mechanics of long-term growth, then this episode is for you. Terry Ryder, thanks for joining me back on Geared for Growth.
Pleasure to be here, Mike. As always, love talking about real estate with you.
Well, we had the pleasure of interviewing you only a couple of months ago about property markets, and this one's a bit of an extra special one because for the first time in 20 years, I think, you've written a new book all about why property values rise. And I would love to think that in the next 20 or 30 minutes, we can answer that question and everyone that is listening is going to be a real estate expert. But I feel like there's a little bit more to it. When you're putting a book like this together, obviously the expectation isn't that someone can read this and completely understand the complexities of the Australian property market, but I assume that there are some fundamental tenets that are a good starting point. Or have I got this intro completely wrong? Help me out, Terry.
No, I think that's quite a good intro. You're right. I mean, you can read this book, and I like to think it sort of distills a lot of the knowledge and so-called wisdom that I've accumulated after 40 plus years of researching and writing about real estate. But it's only through experience and doing things in the market that you really get to understand. Unfortunately, a lot of people learn from their mistakes. There's a section of the book called the 12 rookie errors that people commonly make, because I think what the data shows is that a lot of Australians are really interested in property investment, but not many people truly succeed with it in terms of getting to the point where they own what you might call a property portfolio. Most people end up with just 1 or 2 properties, and it's largely because they make one or more of the rookie errors that I talk about in this book. So it's called Why Property Values Rise, and probably more particularly, it's not so much about why property values rise, but why property values outperform in certain areas. Well, what are the characteristics of those locations that rise a lot more than the norm? Because that's the secret sauce for people as investors, trying to find those places where they're going to get great capital growth over time and grow their wealth and perhaps provide for their retirement.
Now, we've sort of chatted in the past about the business that you founded, Hotspotting, almost kind of lamenting the title of the business because you would much rather the business name be something about outperforming the general market. It just doesn't have that sort of catch to it, right? But that's in essence what we're trying to do. We're not trying to find a place that'll grow 100% in 12 months and then do nothing for 20 years. I mean, that could be considered a hotspot. It's just a thing of timing. But we're talking about, an increase in property prices in a sustained way that's outperforming the general market, or let's just say that state?
Yes. Hotspotting, for a lot of people, their definition of hotspotting would probably be flash in the pan, places that are hot for a short term. That's certainly not our definition, but you're right. I often wish that I'd called it something differently because it conjures up those images for people. And it, sometimes there's criticism of the hotspotting process, but we define a hotspot as a location that's going to outperform the market, and we always take a medium to long-term view. So we're always looking for those places that have the credentials that we look for to outperform, and examining those locations that have been amongst the leaders for the last year, the last 2 years, but more particularly over the last, say, 5 years. What characteristics do they have in common? And looking for places that are alike but haven't had those 5 years of big growth. But always keeping in mind, one of my catch cries is the only constant in real estate is change. So people need to be mindful that what worked previously isn't necessarily going to work in the future. They've got to keep their eye on the ball and understand that change is always happening. And the secret sauce of success, I think, is being amongst the first to see the change and act upon it. Because most people who get into the property market are herd animals. They pile into markets when they read there's a boom happening and thereby miss the best opportunities to buy well in an upcycle.
I've seen so-called property experts talking about things like historical 10-year growth patterns as indicators for the future. That kind of flies in the face of the comment that you made about the change is the only constant in real estate. I wonder, are there some common sort of myths that people fall into the trap that these types of things are worth looking at for the future of property that you've kind of found to be fundamentally false?
Yeah, and that's a very good point. I remember not so long ago reading an article. It was written by the managing director of one of Australia's high-profile property advisories for residential property, and he was listing his criteria that he would need to tick the boxes of for a location that he'd recommend. And the first one was must have a great track record of capital growth in the past. And I thought, well, yeah, a lot of people would agree with that as a very sound fundamental, but it precludes the possibility of change. And what I've noticed about what we do at Hotspotting, we've often recommending very strongly areas that have had poor track records. And the reason for that is we could see the change coming. And an example of that would be around 2020, 2021, when we had the Sunshine Coast as our number one pick in Australia. And for the previous 10 years, it had shown no growth at all to speak of. It had been a very poor performer. But we could see the change coming. And the reason for it was there was like infrastructure projects totaling more than $20 billion happening on the Sunshine Coast, and we knew that was going to be a game changer and transform it into not just a big tourism town, but a serious national and even international city. And that's exactly what happened. So we're always mindful of the fact that while we look for what's performed in the past and what they have, the characteristics they have in common, we're always mindful that new things are coming. And there's one of those that I'd really like to talk about because I think it's a big paradigm shift in what people believe to be true about real estate, and that is the growing outperformance of attached dwellings on capital growth. Because historically, and people often say you should never buy units because they never match houses on capital growth. It's all about the land content.
Yep.
And they roll out truisms like land appreciates and building depreciates, which is kind of a simplistic way of looking at things. But I think that has changed and is changing quite drastically because more and more cohorts are opting for attached dwelling for all kinds of reasons, not just affordability. And we're starting to see quite dramatic outperformance by attached dwellings versus houses in the same location. In more places across Australia than not, we've seen in the last 1 to 2 years units growing their median prices more than houses in the same location. So that's a big shift. That's a big change. And it's a great thing for investors and for young home buyers because it means that, units tend to be more affordable than houses and people can get into a market more affordably and still have that expectation of good capital growth and superior rental yields too you often get with units. So it's a shift that people should be aware of and be happy about, but there's still a lot of pushback from people who say, no, I've got to buy something with land content, otherwise you're not going to get capital growth.
And those same people, I'm thinking, would be prepared to go into far more regional areas, or let's just say areas that don't have a shortage of land supply, just to get the house, rather than something that might be considered a little bit more of a blue chip property that's a detached dwelling with maybe more provable and better fundamentals. You feel like that's fundamentally a wrong way to go?
Yeah, it is. It is because it's not showing a great deal of depth of knowledge about what's happening in real estate. What I've observed, particularly in recent years, is the capital growth, the best capital growth is happening in all sorts of places that people probably wouldn't expect it to happen. The cheap down market areas have been amongst the best performers in the last 1 year, the last 5 years. The locations that people probably wouldn't expect are leading the nation. And an example of that is when we got to the point of 5 years since COVID, so it was about March of this year, one of the big research houses published that the top places for capital growth in houses for the 5 years since COVID struck. And the national top 10 list were places that will probably amaze people. A lot of the places on that list were places that many Australians would never have heard of, let alone know anything about. I mean, number one was Murray Bridge in South Australia, a place that we've certainly recommended over recent years because we could see what was happening in that market. Number two is Kingaroy in Queensland, which is another small regional centre that most people of my vintage in Queensland know about it because that's where Joh Bjelke-Petersen was a peanut farmer before becoming the notorious Queensland Premier for 20 years. But I've spent time there, and it's a very dynamic regional market with a lot happening that people wouldn't be aware of. Places like Warwick in Queensland, Maryborough, and a lot of them were Queensland regional areas, but small to medium-sized regional centres. And it's interesting to look at them because they're all regional. They've all got strong, diverse economies. They all had infrastructure spend happening. They all had affordability, and they all had an element of lifestyle in the mix. So those were the common features, those national top 10 places. But it was a list that would have amazed a lot of people because they would not expect the national leaders on capital growth to be found there.
Yeah. And so let's unpack those particular locations, because when we get, the big economists from the banks and they're picking the growth locations, they're almost always talking about capital cities, right? And I suppose that has broad media appeal. If one of the economists sort of said Kingaroy, they would maybe be kind of think, gosh, that guy might be a bit overworked. Like, nobody's heard of that place. Like, we're not going to print that. We'll just move on to somebody else. But what were the characteristics of markets like that jumped to the top of the list?
Well, it was, I think affordability is a big factor. Affordability increasingly is the thing that rules, and people are just searching for it and finding it harder to find because, the price growth that we're seeing in so many places. So affordability was a factor. Regional, we always think the underlying economy is the important thing. We see real estate as being very local, and it's what's happening in the local economy that matters. So our location reports, they might be 15 or 20 pages like we tend to do our location reports on local government areas rather than suburbs. And if it's 15 or 20 pages, there's only 4 or 5 pages on what's happening currently in the property market. The rest of it's devoted to the local economy because we think that's what's important. That's why we think this area is going to outperform because of what's happening economically, including infrastructure spend. So that was a factor that all those places had in common. They did have lifestyle factors. Some were on rivers, some had beaches, some had lovely country lifestyles. Some were wine regions. That kind of factor was in play. So regional, diverse economy, infrastructure spend, lifestyle factor, affordability. Those were the things that they all had in common.
Yep. I heard one commentator say the biggest mover of real estate prices is the availability of credit, right? Which kind of makes sense because most people aren't using cash. They need access to funds that can, fuel the transactions and those sorts of things. I suppose a way of reverse kind of engineering that is to think about affordability, right? Because availability of credit, if there's an increase in credit, you've got more borrowing power, you've got more capacity to purchase. But an affordable property is perennially popular because you don't need a relaxation of credit policies.
Yeah.
It broadly fits within the budget of investors. So how with all of these factors, do you come with a weighting per location, or are there certain locations where lifestyle is actually a higher weighting than other particular areas? I'm interested in how all of these individual components, you weigh them up against each other.
Yeah. Look, we're not that sophisticated by choice. I'm aware that over recent years, a number of organisations that I know about have been trying desperately to come up with an algorithm or formula that you feed in all the data and it spits out an answer like this is the best place to buy. And none that I'm aware of have actually succeeded. What I believe to be true, and I actually finished this book with some commentary on this, and I make the point that we are data driven, but at the end of the day, it's a judgment call. So I don't think you can ever remove the human element from the decision about where's the best place to buy, keeping in mind that there's not one right answer to that question. The answer is different for every individual. It depends on
Yes.
them and all the factors about them and their lives, or what they already own is a factor. But we have a formula. We call it the empirical formula for locations. And it's an acronym. So each letter of the word empirical means something. The E in empirical is economy. One of the I's is infrastructure. The A is affordability. The L is low risk. So we look for all those qualities in a place we recommend, but we make a judgment call. It's not purely driven by a formula with weightings towards one thing or another.
Yep.
We have a committee meeting, and we talk about all the factors, and we agree on whether or not this is an area that we're comfortable to recommend. So that's the way we go about it.
I remember conversations going back at least a decade with people trying to build essentially AI suburb prediction or house prediction models. And the confidence was interesting to hear. There were comments like, there will actually be one property, not suburb, one property in Australia that is the best investment property to buy in the whole of the what is it, 11 million dwellings in Australia. I mean, that seems mad, but with the computing power that we've got and all of the inputs, do you actually envisage a period where AI is doing all of this heavy lifting for us? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
I really can't, and I'm at the risk of appearing to be a dinosaur. No, we're actually very heavily into technology. I mean, in the last 12 months, Hotspotting has won 3 national awards for innovation in that area. We're trying to make our portal, our website portal, a one-stop shop for people, and we're constantly injecting new tools, new overlays. So we're heavy users of technology and AI to make what we offer better, but the notion that you'll come down to one property in a particular street, in a particular suburb, in a particular city, no. In fact, what the research shows and what we fundamentally believe to be true is that the street doesn't matter, the suburb doesn't matter, the individual property. I mean, in terms of where the capital growth comes from, 70% of the heavy lifting comes from the broad location. It's not the suburb, it's the local government area, or it's the city or the town. That's where you get most of the capital growth. So you can buy an absolutely superb property. Looks like, a multi-million-dollar property, looks great in every respect. If it's in the wrong location, if it's not in a location that's got the economic oomph to drive property values, then it's not going to perform. Contrary to that, a daggy little 2-bedroom unit in a down market suburb in the southern suburbs of Brisbane, for example, I'm thinking of particular examples here, can be absolutely spectacular performers. I mean, small units in Logan City have been amongst the best capital growth performers in the last, say, 2 years in Australia. 30% in a single year, obviously from a low base, but and you've got to look at what's driving this. Well, firstly, there's a change in people's buying habits. More and more people are opting for attached dwellings. But when you look at the locations and what they offer, they may be down market and considered to be stigmatised, but the infrastructure is great, the transport links are great, it's close to a major hospital or a major university campus, all these things might be in play. Trying to find the absolute best individual property is an exercise in futility. They're wasting all that investment and time and energy and expertise to arrive at something that's not going to work. And I was asked the question by one of our clients last week. He's interested in buying in Toowoomba in Queensland, and I'm a big fan of Toowoomba because of everything that's happening there. It's a great case study for what we're talking about. And he asked, well, what's the best suburb to buy? And I said, it doesn't matter. Buy something in Toowoomba, buy an individual property that's close to the basics like schools and public transport and maybe parkland and shops. But the name of the suburb that you buy in doesn't really matter. What's important is buying in Toowoomba. That's the entity that's got all this dynamism in its economy, and it's going to show great capital growth. Another example is the best performer in the financial year just finished, financial year 2025, anywhere in Australia, was Townsville. Every single suburb in Townsville, whether it's unit market or house market, grew more than 20% in their median prices in that
Yeah, wow.
12-month period. So it didn't matter where you bought in Townsville, as long as you bought in Townsville, because Townsville is one of the strongest regional economies in Australia. That's the important factor.
Yeah, yeah, and that was actually the number one statistical area 3 location in our data for 24-25 as well. So that
Yeah.
was good to see. A lot of investors getting in there and having some great results. So I'm interested to sort of unpack a little bit more that comment that it doesn't necessarily matter the suburb. There must be a point where some granular research around things like demographics can weigh into the property type. So, for example, if you ring around the local property managers and they say, we are desperately trying to get 3 bedrooms, no one wants a 4-bedroom, are those some of the things where you can kind of go, okay, well, the property type and maybe the streets that house those properties might inform us narrowing that search from a greater location like the Toowoomba?
Yeah, I think so. I mean, the big decision is the broad location, and having made that decision, then you can start to drill down a bit. And I often find, in my experience, that the anecdotal evidence is the most powerful. You know, speaking to people at the coalface, who are living and breathing the local market every day can give you great information about what you should buy and what's working and what's in short supply. Local valuers, local selling agents, property managers are great because they don't necessarily have a vested interest in putting a spin on anything. And I always have conversations with property managers, on the basis, look, I'm about to buy a property in your area. I'm going to need a property manager. I just want to ask a few questions about what's happening in the market, and just along the lines that you've just outlined.
And I suppose, yeah, property managers, I would say, are better than real estate agents because real estate agents might be more transactionally focused. But a property manager has that extra little spin where they don't want to manage a property in what they consider a problematic area, right?
Yeah,
They kind of want easy things. So if they say, oh, I wouldn't buy there, it's another way of saying, I don't want to manage something there, which is an interesting insight, right?
that's right. And also down to individual properties. Quite often you can get a property manager to pop around and have a look at the property that you're looking at buying, and because you quite often you're buying remotely, you're not having the opportunity to inspect it yourself. And property manager will come back and say, look, I wouldn't want to be the property manager for that property because I can see so many problems. Or they might come back and say, look, it looks great to me. I'd be happy to have that on my rent roll.
So I want to change direction quickly. In terms of your career and your knowledge and your research, there's probably nobody that's spent more time researching property markets over as long a period of time as you have. What has surprised you over that journey in respect to markets that have outperformed, or perhaps markets that had all of those fundamentals, like the local economy is booming, there's a big infrastructure spend, it's got lifestyle appeal, but it just seems to be on life support, and there were, it didn't move along, or when you have all of those metrics joined together, does that just not happen?
Like, what surprised me, I think one of the things I learned early on was that ugly real estate grows in value.
Hmm.
And that's something that I've sort of carried through, because when I was first getting into it, and this was the early 1980s, buying my first home, there was some strong beliefs about, the prime areas, the ones that outperform. And if you're buying an area like that, you're never going to get capital growth. So I was surprised to find I was forced by affordability to buy in a down market area in a pretty daggy little house, but I wanted to get my foot on the ladder, and it grew fantastically in value. And I think it's one of those principles that may be still a constant in real estate, and that is that people always are looking for affordable options, and they don't necessarily care that real estate snobs look down upon that area. if they can afford and it's got good basic infrastructure that they need, then they will rent or buy there. So that was an early learning. I thought early on that the way to success was to buy something and it grew in value, sold it and bought something better. You traded your way to success, and I wish I could have all of that time over again, because what I bought for literally $25,000 in 1981, I think, would now be worth about $700,000 or $800,000. And obviously, I wish I still owned it. And the second one that I bought was closer to where I needed to be in Brisbane for $50,000, sitting on a hill with views up the Brisbane River. The land alone would be well over $1 million, but I don't own it anymore. And so one of my big learnings was never sell, accumulate, buy good real estate assets, keep them, and just grow a portfolio. So that was a learning along the way.
On those, let's call them the ugly duckling suburbs, or they just don't sort of leap off a shiny brochure in terms of their aesthetics, there's a bit of a dialogue that's bouncing around with buyers agents at the moment that are basically saying there is a point where they see value, and that might be, I mean, we're in November, December 2025, and there's some agents that are saying, look, unless you have 750, I couldn't in good faith recommend a location because of all of the inherent problems that come with that price point. That kind of flies in the face of your advice around affordability, or have I misread that? And I kind of wanted to get your thoughts on that.
Yeah, depends what they mean by what they're talking about, but there may be an element of real estate snobbery. Look, I do agree that if you're buying in those affordable areas, sometimes you're buying in an older stock, and there may be maintenance issues along the way. Now, I've just yesterday got an email from the property manager of a property I own, and I always buy at the lower end of the market because of everything I've learned and everything I'm talking about today, outlining a list of maintenance issues that need to happen with that property. And I looked and thought, well, what a pain in the ass that is. But none of them are serious things. They're just minor things. They're things that a property is a little bit older, tend to go a little bit wrong, need to be dealt with. I have to spend $2,000 or $3,000 getting all these things fixed. But that property is growing in value at like 80 to 100 grand a year. So do I care about those minor maintenance issues? As long as I don't need to replace the roof, which would be a seriously expensive exercise, as long as it's just these minor maintenance issues, I'm still miles ahead. And the capital growth is just extraordinary. One of the examples I wanted to touch on was, there's probably no better example of this factor anywhere in Australia than the northern suburbs of Adelaide, the city of Playford. And there's 8 suburbs with Elizabeth in the name. That's about as down market and stigmatised as real estate gets anywhere in capital city Australia.
You would think the Queen would add a little bit of prestige to the markets with Elizabeth in there.
Well, that's right. Well, they were named after Queen Elizabeth, but not because the suburbs were regal in nature. Right. Quite the opposite. This is seriously down market stuff. But the capital growth in the last 5 years has been probably the greatest anywhere in capital city Australia. Most of those Elizabeth suburbs have been 5-year growth averages above 20% a year, like 20 to 25% a year, all of them. And what you could have bought 5 years ago for $300,000 is now about $600,000. Now, they've more than doubled. And I had that experience myself. I didn't buy in the Elizabeth suburbs, but 5 years ago I bought in the northern suburbs of Adelaide for $310,000. For various reasons, I decided recently to sell it to reduce some debt in other areas. And I got 7 offers around $700,000 after one open house. And so more than doubled in 5 years. And that's extraordinary performance, because media gets excited about property values doubling in 10 years, but some of these areas have done it in 5. And it's just another example of how down market stigmatized areas, regardless of the socio-economic factors, the low incomes, the crime rate, and all those things that people worry about, regardless of all that, these places have been absolute stars on capital growth.
Yeah, that's interesting. I want to see how much of this book that we can basically rip off from this chat without buying it. No, I'm being a bit silly, but the 12 rookie errors you sort of prefaced before that prevent success. Are there a couple of standout ones that you're willing to share with us today?
Look, yeah, I think probably the biggest single one, the one that really keeps coming back to bite people, I think, is so many people aren't willing to spend money on advice and information. I think this is a mistake so many people make. They try to penny pinch their way to success in real estate investment, and you can't. So, you know, they're willing to get a loan and buy something for 500,000 or 700,000, but not willing to spend a few $1,000s on getting buying good information to make sure they're making a wise decision, buying in the right areas. Speaking to mentors, using a buyer's agent, a well-qualified buyer's agent, help them find the right property and try and get it at the right price. You might spend in that exercise, $20,000, but if you're buying in the right area, the capital growth in 6 months is going to totally take care of those costs, and then you're ahead. But so many people aren't willing to spend any money at all on information and advice, and I think it's the worst kind of false economy.
Well, I mean, just think about the amount of brain power and research and knowledge that goes into your reports, right? The price that you need to pay for to be able to leverage that. I mean, that's a pretty solid ROI. And the difference between a property that maybe does 8% growth compared to 6% growth, I mean, that blows the cost of a research report out of the water, and perhaps even a buyer's agent's fee as well, right?
Well, absolutely right. If you're buying in the right areas, and in a matter of a few months, the capital growth that's accumulating more than takes care of those initial costs of buying, and then it's all blue sky, apart from the capital gains factor, capital gains tax factor.
Yes. Now, I want to ask you a question that I always feel awkward about it every time, but I know that people listening will be annoyed at me if I let you get away without some sort of prediction. Now, the last time we spoke, you talked about second wind markets, so markets that have had a run previously but have sort of paused to take a bit of breath. I think one of the examples you gave was Bundaberg. For investors that are looking for success in 2026 and beyond, what advice can you give us? Where should we be looking?
Well, in terms of the markets that are starting to come strong, under the theme that change is constantly happening in real estate, I did that presentation in Sydney earlier this week, and I had a slide that had this is what happened in 2024 in terms of price growth in the capital cities. This is where it was at 6 months later, and this is where it is at almost 6 months further on at the end of this calendar year. And there's been enormous change in the pecking order. And just reinforcing the point that change is constantly happening. So 12 months ago, Perth was the leader, and it's certainly not anymore. Melbourne was in the negative, and now it's rising up the pack. So in 2026, I'm expecting to see outperformance in Victorian markets, regional Victoria and Melbourne. Some of the locations in regional Tasmania as well. Darwin's still going to be going very well. It's currently leading. 12 months ago, it had zero growth, and now it's leading the nation on capital growth. It's gone from the bottom of the pack to the top very, very quickly. So those are the things that I would be talking about in terms of what we expect to happen next year. I think we are going to get, as a generalisation, some pretty good growth because of all the forces in play. We still have that shortage factor. We have a lot of forces driving big demand. A lot of scapegoating going on. People blaming immigration. Well, immigration is a factor, but it's not the prime reason. Some people are blaming the federal government scheme to help first-home buyers. It's a factor, but it's not the primary one. Tax breaks for investors. It's a factor maybe, but it's not the primary one. Interest rate cuts, well, that's become less likely going forward, hasn't it? But but the ones we've already had, a lot of people blame them for affordability getting worse. They're all forces in play. The biggest single one that's never talked about for us is the infrastructure investment that's happening around the country. We think this is a huge catalyst of real estate markets, and right now we have an unprecedented level of infrastructure investment. It totals something like $900 billion.
Wow.
And I often say to people, if you want a simple formula for success in terms of where you buy to get great capital growth, follow the infrastructure trail, buy real estate that lies in the path of progress. And to make it even simpler, just look where they're building the big billion-dollar hospitals.
Yep.
One of the reasons why I was talking about Bundaberg is because, A, it's a great regional city with a really strong economy, lovely place, lovely lifestyle going forward. But there's a $1.2 billion hospital just starting. And I know from experience that there's going to be 3,000 or 4,000 jobs in building it and probably 5,000 jobs in running it when it's finished. And those people are going to come from other parts of Australia to live in Bundaberg. So imagine what that's going to do to in terms of demand for real estate in that market. Now, these facilities, these big hospitals are being built all over the country at the moment. There's one happening in Toowoomba, there's one happening in Frankston and Melbourne. There's multiple of them happening in different parts of Sydney. There's dozens and dozens of them, and their impact on real estate markets is quite considerable. So follow that infrastructure trail, and it's not a coincidence that the Frankston area of Melbourne is absolutely screaming at the moment in terms of buyer demand. It's got other factors, other good qualities, but the game changer, the X factor, is this hospital development.
Mm. And I mean, that was not that long ago. I remember that being really an ugly duckling suburb, but I actually went down there to watch the first, it was Ironman Melbourne, and never been to Frankston before, was standing on the beach watching the swim, and I thought, this place is beautiful. It's actually a really stunning location.
It's a great location, and it's got rail links to Melbourne. It's got the big motorway link. There are lots of jobs down in that part of Melbourne, and now they've got this extra big factor. So I know members of our team that are based in Melbourne have been going. They often go to auctions just to get a feel for what's happening in markets, and they've been to a few in Frankston recently, where the final result has just completely exceeded everybody's expectations. This issue about underquoting and revealing the reserve price. Well, it's a very difficult. I mean, I know some real estate salespeople sort of have difficulty identifying the truth, but it's really hard in markets like that to have an accurate price guide, because the property had an expectation of 700,000, a realistic one, ends up selling for 830,000. I mean, and because there's so many people competing to buy it. So you're getting results like that in places like Frankston now, Melbourne. That's one of the reasons why we see Melbourne being one of the outperformers next year after several years of underperformance.
Mm. So we follow the infrastructure, which leads to jobs, which leads to scarcity, especially with people moving in. It leads to affordability, I suppose, because where there are good employers and good job opportunities, that kind of factors into it. The new book, Why Property Values Rise, what else can we expect from that, and where do we get it, Terry?
Well, as they say in all good bookshops, but you can also get it from Amazon and also Booktopia. And I'm very happy that Booktopia's just put out their Christmas catalogue, and they've featured this book in their Christmas catalogue. Also featured in Money Magazine last month as well. So it's getting a bit of attention, but you can buy it in bookshops or you can buy it online on Amazon and Booktopia. Look, one of the big points I try to make throughout is real estate is local. Understand that the fundamental thing that's important is the local economy. It's not what's happening in that market now in terms of prices. Is the local economy strong and diverse? Are jobs being created? Are people coming to that location to take those jobs and create demand for real estate? Understanding that sort of really basic fundamental is part of the way to understanding what's going to work in real estate investment.
Awesome. And that, I think, is a perfect way to finish. Congratulations on the book and best of luck with that, and wishing you all the success. And thanks very much for joining me on the show today.
Okay, Mike, always a pleasure to come on and talk to you about real estate issues. I love it.
Careful what you wish for, mate. We'll have you back. See you soon.
Okay, thanks.